Risk appetites on a mend, albeit cautiously, as uncertainty over the corruption investigation prevails. Last week, Philippine Stock Exchange fell below 6,000. The peso climbed to 58 to the dollar, and 10-year bond yields fell below 6%. At the end of this trading week, PSEI is back above 6,000, a peso a touch stronger versus the dollar, and the yield on the 10-year Treasury is under 5.9%. Well, with us now for more on the market state of play, April Vitan, the Chief Equity Strategist at COL Financial. Good to see you again, April. Welcome back to the program.
Hi, Kathy. Thank you for having me.
All right, so how are risk appetites holding up? We started this week with bargain hunters pouncing into action, but that's coming from the previous week's drop below 6K on the index, coupled, of course, with a weaker peso and the foreign fund outflows.
Yeah, I think investors are still a bit cautious at this point. I think one of the factors causing them to be cautious is, aside from all this investigation into corruption, of course, is the weak peso. There are concerns that the peso could depreciate even further if the US dollars strengthen. So, I mean, historically, a weak peso has not bode well for the stock market.
Why not?
I think it's for foreign investors because, of course, you don't want to own peso assets and then all of a sudden see the value of the peso depreciate against the dollar. So, I mean, that would mean more losses for you, right? And the foreign investors account for around 50% of value turnover in the Philippines, even to this day. So that would have an impact on their demand.
So when you compare the unknowns of markets face at the start of this year with the uncertainty of Trump's tariffs, with the unknowns of how the corruption investigation is panning out, which one do you think is the bigger market risk?
Well, I think it's really the global economy. I mean, there are a lot of factors. I think if you look at what's going on globally, one of the major frustrations, even for long-term investors in the Philippines, is that it has severely underperformed global markets. And I would say that one of the reasons why that is the situation is even if you look at the global markets, the movers really are the tech stocks, which unfortunately we do not have any of. So I think that's it. And then maybe if earnings were good as far as corporates are concerned, then some investors would worry less about these other issues. Because if you look at the different, members of the Philippine Stock Exchange, you would see pockets of strength depending on the outlook of these stocks. Unfortunately, most of the large caps aren't doing, I mean, it's not that they're not doing well, but their earnings are just not exciting enough to, I guess, attract new money to come in.
But where are those pockets of strength, and what is keeping them from saying, deploying a lot more capex to make it a lot more interesting?
For example, for this year, I think one of the best performing sectors would be the REITs. So it's not that they're not, okay, I would say that they're not deploying capex. It's more like you're seeing a lot of them injecting new assets into the REITs because you can see that the environment is very favorable for them. Interest rates are going down, valuations are better. These companies are seeing, for example, the office leasing space and the mall space picking up. So because of that, they are expanding their mall footprint and even their office footprint. So they are, the sponsors are raising capital by actually injecting these assets into the REITs. So I would say that there is no capex. I would say maybe more subdued capex because again, it's not an across the board strength as far as the economy is concerned, but there are pockets of strength and these companies are investing. And then of course you have, say for example, Meralco announcing aggressive expansion plans for the next 5 years. And then solar power is also a big thing. So you would also have these renewable energy companies expanding their operations.
Well, to us about the consumer because we're a domestic-led market, as you did point out in the series of conversations we've had in the previous months when Trump's tariffs were the bigger concern. How is the consumer holding up now against the prospect of an even slower growing economy because the taxes didn't go to where they should have?
Well, consumers are, surprisingly doing better. I mean, even if you look at the BSP Consumer Sentiment Index and the survey, it shows more optimistic consumers because there are more jobs and of course inflation is going down. So it's quite resilient. The problem is if you look at the consumer companies, what they are encountering right now is higher cost of selected commodities. Um, so, for example, you have the manufacturers saying that they're suffering from high palm oil price, coconut oil price, high coffee price, and these are hurting their margins. But if you look at the top line, it's actually still growing strongly. So, in that respect, I mean, it's not all bad. But then at the end of the day, if you look at the profits, you have to consider both the top line and, of course, the cost side.
Right, we've heard it straight from the Bangko Central governor himself last October 9th. Inflation not much of a concern, but he is keeping a close watch on business sentiment by way of tracking the direction in the stock market as well as the peso. And he's also going to see how our third quarter GDP checks out on November 7. What are you projecting for monetary policy direction in December and into the first part of next year?
Well, looks like the BSP is inclined to, is more dovish and is inclined to keep on cutting rates. So it already said that from 5%, it expects the Goldilocks interest rate to be more like 4%, implying that the move is to reduce it further in the next few meetings.
What impact would that have on bank stocks, if you will, because we're watching on the net interest margins and also the loan loss provisions, and the bank earnings have started to come out with BPI starting the train there.
Well, it's different. The big banks would be more vulnerable to lower margins, because they have a large pool of low cost deposits. On the other hand, for the smaller banks, the impact on margins is better because they're more dependent on time deposits whose costs have gone up because of the higher interest rates. So the lower interest rates would lead to lower cost, and margins should improve. So it really is mixed.
All right, well, we'll have to leave it there. Thank you so much for looking at the silver linings that lay ahead on the markets. April Litano of COL
Okay.
Financial.